Welcome back, everybody. Today I have something a little bit different for you. I had the opportunity to talk to Dr. Ankur Crawford from Alger, and I'd seen a bunch of her interviews on CNBC and really appreciated her thought process on markets and especially tech companies and AI. And I saw a lot of overlap in the companies that she talked about and the ones in my own portfolio. So I think you're really going to like this conversation. We talk about markets and AI and big tech and their concentrated equity ETF. And it's great to hear her perspective on all those things. And I will say with the audio in this video that I recorded from Zoom, my voice sounds super deep, like even more deep than normal. So I don't know what that's all about. But the important part is that her part sounds great. And that's someone you need to be listening to anyway. So let's jump right in. Welcome, Dr. Ankur Crawford, EVP and Portfolio Manager at Alger. Dr. Crawford, it is great to get a chance to speak with you today. Thank you for being here.
Thanks for having me, Matt. Looking forward to this conversation.
All right. Well, cool. I want to respect your time. So let's kind of jump right in. And I wanted to start with a question, maybe more on the macro side, which is probably not as interesting as the stuff that we'll probably talk about, but I think it gets talked about a lot. So I'd love your perspective because there's so much talk around about rate cuts and people wanting to hear about what the Fed's going to do. How much do things like rate cuts and maybe macro overall influence how you view the market and investment decisions? And, maybe an extension of that is how important do you think it is for regular retail investors who are just managing their own portfolios?
Yeah, look, I think you can't be macro unaware or kind of unaware of what's happening um, on the macro side, because in part there are periods of time where you do need to pay attention to what the Fed is doing, i.e.,
Yeah.
the big transition in November of 21 was an important transition to take note of because that was a big pivot. I think this transition has been well anticipated, and it is notable, but we've already anticipated in the market that the Fed is going to be cutting. And and the question really is, how much do they cut? Or how much do
Right.
they need to cut? And that's a function of the economy. It's a function of, how much does GDP slow? Are we going to have a soft landing? Are we going to have a hard landing? So, but it really goes back to the fundamentals as well. I mean, if the
Right.
economy isn't doing well, then companies are going to miss their numbers, which means that the S&P earnings numbers is going to come down and the multiple will go down on the S&P, right? Which will
Right.
warrant a rate cut that is beyond, kind of the expectations of what people think. So it's a bit of a, you start with the fundamentals and you see what the impact of the rate cut is. And if the fundamentals don't get any better, you have to continue to cut rates. And so when I think of portfolio construction and how do you position in a market like this or during these transitions, I think you have to be aware of what's happening. So might you add a little bit more interest rate sensitivity to a portfolio at that point in time?
Right.
But it doesn't mean that you should change your overall philosophy.
No,
So,
yeah. Sorry, go ahead.
and I was going to say for retail investors, I think unless you are living this market on a day-to-day basis, I think it's just tough. It's tough to reorient your portfolios, with the newest topic du jour on a weekly basis. So you just have to own what you believe in and own companies that can compound their growth.
No, I love that. And, one of the things that we talk about a lot on my channel is trying to ignore the noise a little bit and concentrate on what's your strategy, what's your risk tolerance, and those things, may change over time, but they shouldn't change with a headline every day, right? But okay, but let's move on to something that I really wanted to get to because I've heard a couple of your interviews before, and as recent as maybe a month ago, I heard you say that the AI trade is still in the early innings. And what are some of the reasons why you feel that way, in contrast to a lot of people out there who say, you know what? The AI thing is a bubble, is going to come crashing down. There's no ROI on these investments. I would love to get your perspective on why you think it's in the early innings.
Yeah, so my very big perspective, I'll start big and we can get a little bit narrower, is that AI and what we're seeing today is a fundamental change in the foundational technology of how we compute, right? It's
Yeah.
it's it's accelerating us into a period of time where software begins to write software. And when software begins to write software, innovation becomes exponential. And if you think about the impact of what that actually means, that innovation becomes exponential, you will understand why AI is not in a bubble, right? Because when we start thinking about the endpoint for AI, And maybe that endpoint is having a digital version of yourself that sits with you and does many of the things that you might have done, but in an intelligent way, not just the mundane tasks, and actually may do them better than you do, right? And enhances your work product. What is that worth?
Right.
When we think about, you know, kind of CapEx replacing OpEx, or we think about what productivity we can add using AI. And it's not today, right? We're not investing today for the revenue today. We're investing today for revenue and for a path to revenue over the next 4 to 5 years. And so I think the misnomer that people have today on AI is that, AI in its infancy is not productive enough. So why should we pay for Copilot? Because, it's only 10% productivity. It's not worth it to me. But
Right.
this is version 1. What does version 3, 4, and 5 look like? And how much productivity will it add? I will cite, like, I don't know if you've seen the Klarna CEO's commentary.
Yeah, I was going to bring it up actually. Yeah, I just saw it today.
Yeah, it's amazing to me. I mean, he said
Yeah.
this maybe 2 weeks ago on a podcast. And first of all, what's amazing is he's saying that, he's disrupting enterprise software.
Right.
That is, which has been core to one of our thesis here at Alger. But he's also talking about how many people he's able to kind of digitize effectively, or how much work he's able to digitize. I think that on the order of 700 agents, he was able to digitize, and the results were equivalent. And he took response time from 11 minutes to 2 minutes.
Right.
So that again, that's version 1.
Right.
Version
Huge,
5
and
seems
it's huge
kind of,
ROI already, right? I mean,
it's
at
a
that point.
huge ROI already.
Yeah,
So I don't know. When I hear people talk about the AI bubble, I feel like the endpoint of how they're thinking about the market is a little narrow.
for sure. No, it makes sense. Um, I was going to bring up the Klarna thing. I'm glad that you did, because I'm really interested to see if more stories like that start to come out, where people are literally saying we ripped out this enterprise software that was probably a bunch of their expenses, right, and got better for much cheaper and ongoing cheaper, right? So that has huge impacts, and I'm just interested to if we hear more stories like that over the next year, 2 years, whatever. I think it'll be interesting to know. But yeah,
Yeah, we actually wrote a paper about this a year ago. It's called The Declining Cost to Create. And it goes through what happens when you can create software for free. Or I call it for free, but I say the
right,
cost goes to zero. I call it to just exaggerate my point.
right,
But what happens when you can create software for free? I mean, what happens to the enterprise software? What happens to their business models? What happens to
right,
the multiples? And so this is also why I think, when we think about AI and the speculative bubble, um, maybe it's time to make room for a new kind of technological advancement, which takes market cap away from what we've grown up with over the last 2 decades.
right. That's super interesting. And so I think kind of as we continue talking about this, specifically about the concentrated equity ETF, I was taking a look at it, and I know we're going to talk about it in more detail here, but I noticed that, big tech is heavily represented in that fund. And I'm a little curious about that. I think it kind of happens to connect to what we just talked about in terms of why. But in my own portfolio that I share on my channel, I have a very similar allocation. I think over half of my stocks in my portfolio were actually in the fund, which is why I was super interested in it to begin with. But I know why it made sense for me, but I'm curious to hear your thoughts on big tech kind of continuing to drive the market. In contrast or compared to people who say, you know what, that runs over, it's done, it's time for more small cap value and all those things to kind of broaden out. Kind of what are your thoughts on that?
Yeah, I think we're in the early innings of this ramp in AI. And the companies that are going to be driving this evolution slash revolution are actually going to be the big tech players. Whether, definitively a Microsoft of the world is going to, um, you know, kind of take the catbird seat on where we're going in this platformization change. I think companies like Meta and Amazon, with Amazon with their cloud and Meta with really applying AI and broadening their industry from just an advertising business to a marketing business and being able to pivot. Um, I think these are big changes. And we tend to invest in change. Our core philosophy is investing in change, and in part because where there's change, oftentimes the market underestimates how much change there can be, and the numbers tend to be too low, i.e., Nvidia,
Right.
right? And so, I think that there's still room to run for a lot of these businesses, and in part because if you look at the valuations, they are not stretched. I mean, two days ago, was it? I mean, Nvidia's trading at $114 today, but 2 days ago it was trading at a
Right.
20 multiple.
Right.
Um, Microsoft, same thing. At a $405, it was basically trading at a low 20s multiple on a 26 type number. So does that feel like the run is done? It doesn't. And in
Right.
part because the numbers will continue to accrete. These are definitive growth markets. And the multiple should expand from a 20 multiple. And I mean, I think I'm looking at Meta, like Meta just again, maybe a week and a half ago, it was trading at a sub-market multiple.
Right.
Is that an appropriate multiple for a business like Meta? I would say not. And so looking at the fundamentals, I would say, we're not done yet. Microsoft in itself has probably not performed as well as one might have expected. It's only been a market performer this year. So
Right.
it has treaded water. Amazon, the same thing. It's since February, it's really gone nowhere. So we've already seen this period of underperformance, interestingly enough. So I
Yeah.
don't think that we have like another year of this underperformance, to be completely frank.
Yeah, I think it's an interesting perspective too, especially because how much those businesses have come down even just over the past week. It's just kind of that whole story of being overpriced and stretch seems a little thin, to me too. But let's move on to talk about the concentrated equity ETF a little bit. So it's an actively managed ETF. Would you say when I looked it up, said quote promising it looks for companies with promising growth potential. Now, I think you probably touched on it a little bit when you said you invest in change, but without revealing anything proprietary, of course, if there's anything you can tell us a little bit about the type of companies that you look for that ETF in particular.
Yeah, so concentrated equity is basically the ticker CNEQ, and it's anywhere from 20 to 30 names. We've been airing on the higher end of that, 29 names today. Um, Look for businesses that are core of growth, i.e., they're businesses that are either changing the industries that they live in um, radically, or they have a special kind of positioning in their industry. So I would posit that about 50% of the names in concentrated equity are oligopoly type characteristics, whether or not they're oligopolies. But they have kind of those characteristics where they have great pricing power. They are still in growth type end markets, or they're demand creators in their markets. And this could be businesses that range from any of the big tech companies, whether it's a Netflix or a Microsoft and Nvidia that are, I mean, Nvidia is definitively a demand creator. Um,
Right.
and so all of these businesses have pricing power, in part because of the market that they live in. But there are companies like Formula One, that is a media company that also has pricing power with very different characteristics, or Ferrari that caters to a very exclusive market, but has incredible amounts of pricing power for a car
Right.
company. So I would say so half of the portfolio has those kinds of characteristics of really special businesses. Um, and then half the portfolio is levered more to kind of companies that are just, they're not necessarily oligopolies, but they are somehow changing their business models, and they are growing at a rate in excess of not only the market, but their own markets, i.e., they're taking share. They are, again, have pricing power, or they have very large markets that they're addressing. And companies that I would highlight here are companies like Astera Labs, small semiconductor company that was made in a garage really in 2017. And we predict that, or the market predicts that they're going to have $1 billion in revenue in 27 or 28. So it came out of nowhere and highly successful. Or a company called AppLovin, which is a kind of a advertising agent for gaming systems. So these are what we deem kind of special type companies that are going to kind of flourish and grow and give off an immense amount of free cash flow over the next few years.
So one of the things that I like to do when I look at ETFs, right, is I try to understand a little bit who it's actually meant for, right? Like not every ETF is meant for every investor, and it's based on what it's trying to accomplish. And I know you've touched on that, but what type of investor do you think the concentrated equity ETF kind of makes the most sense for? Like if you had a target investor customer, who is that?
Yeah, look, I think initially, to understand what CNEQ, it's 30 names. So it's not that concentrated. It's not 10 names where it should have a huge amount of variability relative to a growth benchmark. But most importantly, it's non-diversified. And a non-diversified fund it's a relatively new offering. And what it means is that you're not constrained by the 40 Act rules that the SEC put in place many, many years ago that really handcuffs a lot of portfolio managers today. So, and that is an important aspect of this fund because the position sizes can vary pretty significantly relative to the benchmark. I think the other thing is that, and it's not necessarily concentrated equity, but at Alger, we have a very large team of people that are working on understanding and developing these business models and developing these ideas that make their way into the portfolio. This is basically 30 of the best names that I can find across our research staff. So one thing that we are is very good stock pickers, and we can pride ourselves in our philosophy lending itself to that. And so what you're getting is really the best of the best through this concentrated equity. So for any kind of investor that's looking for growth and looking for the characteristics of having businesses that should grow faster than the market on the bottom line, not the stocks. Looking for businesses that have pricing power and have unique business models, I think this is the kind of ETF for them.
No, I love that. That's great. And I want to talk a little bit. I saw in the documentation, the conversation about expense ratios always comes up anytime anyone talks about any ETFs, but especially actively managed ones. But I saw that you guys had a waiver, I think, until the end of 2025. I don't know if you just wanted to talk about that real quick, or kind of what the waiver does.
Yeah, the waiver basically for a young fund, there are a lot of expenses that generally get put onto the consumption base or the investors in the fund. And what we're doing is we're offering a waiver such that those expenses are actually are borne by Fred Alger Management by Alger. And so, that way our new investors are not burdened by the fact that it's subscale today.
Very cool. So I know that I want to respect your time here, but I have one last question for you. It's a two-part question, and I think you've touched on it already, but I'm curious to hear what you think about this. So one, what are the trends that you think are going to be the most impactful for investors over the next decade? I'm sure you probably touched on some, but if you have any others, that'd be great. And then two, what's something that, whether it's a trend or actually part of one of these trends, that you think the general public or investors at large are underestimating right now?
Yeah, I think, and I did answer both of these in kind of due course of our conversation, but
Yeah.
it's definitively AI, right? I think if you think about AI, and again, if you think about the endpoint of what AI is going to be, um, it kind of is a paradigm shift in the way we have to think about our world. And that's why you see, $200 billion being spent in CapEx, because
Right.
there are some in the industry that recognize where we're going and the impact it can have. And, I think we talk about it in terms of businesses, but I think there's a lot of geopolitical aspects to this that, I believe that the market is underappreciating and how important it is from a geopolitical aspect that we maintain AI dominance. Um, I think that's kind of underestimated. I think the pace at which we can get to kind of a superhuman intelligence period of time, I think it's going to come faster than people think. I think that, there's a long slew of other kinds of investments that are going to be made. Today, we're talking about data centers. Well, what
Right.
happens when, for example, a data center needs to be connected to another data center? My gosh, then it sounds like
Right.
2000, where you have to lay all this cable and then you have an optical cycle that is decades long because the entire globe will have to connect data center to data center. What happens when you go into IoT? And IoT
Right.
becomes a reality because you can use that information to become more intelligent in whatever you're doing, right? That requires a different kind of networking. So I think it's almost like the data center is the first entree into AI. And as we start to spread out AI into the edge, into even geographically, as we're spreading out these data centers based on where electricity is,
Right.
it has this impact on economies that I think is going to be surprising. And there's going to be big CapEx spending across the board, whether it's utilities, whether it's on optical and that aspect, on the edge network. I mean, I saw something he had done on Cloudflare. Totally,
Yes.
totally agree that, over time, that edge aspect is going to be really interesting and really
Right.
important. So,
So,
yeah, I think that covered both of those
yeah,
questions.
no, that's great. And actually, you had mentioned like all the CapEx spend, the data center spend. Just real quick, I would love to hear your thoughts on, part of the Nvidia. Obviously, Nvidia is a huge name that everybody talks about almost daily, and everybody has very strong opinions about Nvidia on both sides. And one of the prevailing kind of, I don't know if it's criticisms or whatever about Nvidia is that eventually the hyperscalers are going to stop spending. They're making their own chips, and what does that mean for Nvidia's future? I'm curious, without having to predict exactly what's going to happen to Nvidia. How do you view that kind of viewpoint of, hey, all the CapEx spending is going to stop and Nvidia, like their revenues are going to just die?
Yeah, I think it's ludicrous. And I think it's ludicrous because again, if and let's just play out the math behind this. And I'm going to make up these numbers, so don't hold me to them in
Okay.
4 or 5 years. But if I could, you know, give you an agent, right? And that agent did, I don't know, 50% of what you did with your day. Or I could, and I'm going to cite Eric Schmidt, where Eric Schmidt talked about how you can create an agent that for you could say, create an avatar of me and have a video that goes viral. I want you to make a video of my avatar that looks exactly like me and speaks like me. And I want you to have it say something with these boundary conditions. So it's not like way out there,
Right.
that goes viral. And all of a sudden you
Yeah.
have a video that goes viral and you are able to double and triple your base of
Right.
users. What is that worth to you?
Yeah. I
It's
mean, it's
worth a
unbelievable to
lot.
think about. Yeah.
Right. And, and
100%.
and we're not that far away from that, right? So if Microsoft, let's hypothetically say Microsoft can offer that to you, or Microsoft can offer me a mini me in in a, in part of my thinking, right? How much would we pay for that agent? Could we pay, many tens of thousands of dollars for it? I would say we would, right?
Right.
In enterprises, we would pay many tens of thousands of dollars for it. Today, Microsoft may collect $1,000 per seat, and the opportunity is many tens of thousands.
Right.
So when you put it in that perspective, Microsoft shouldn't stop spending because in order to get there in 5 years, they have to make all the incremental CapEx spend that is happening today to refine and train their models. And I use Microsoft loosely and just to explain my point. It could be
Sure.
any one of these companies that can offer you this digital agent, that goes and does work for you. I mean, Jensen today was at the Goldman Sachs conference. He's the CEO of Nvidia.
Mhm.
And he talked about AI not only replacing kind of data center, like old data centers, he's talked about $1 trillion of data center compute out there that needs to be replaced by accelerated compute. He talked about how skills are going to get replaced by AI, and our AI is going to produce skills or be able to have skills. And this is along the same lines of thinking as what I just illustrated. So hearing him say that gave me more conviction in where we're going and more conviction that, everyone thinks that, CapEx is just going to stop. I mean, CapEx is not going to just stop because again, if you think about where we're going and the endpoint for monetization, it is order of magnitude higher than what can be monetized today. And how much do you spend to get there?
Right. You know what's
So,
fascinating about that is when we mentioned like the having like an agent that can do these things, they look like you, they, all that type of stuff. You know, there's one aspect to that where it's the actual like the productivity aspect, right? Where hey, you can do these things, make a viral video. But then there's the aspect of hey, you could get all of your time back because you have somebody who can do these things, right? So how much would you pay for the one resource in your life that's not renewable? A lot, probably, right?
right.
So I think that's a really interesting angle. I love
Yeah,
that.
and the thing is, Matt, we're not that far away. It's going to happen. We've seen all of these mega transitions in our own careers over the last, 2 decades. And we're not that far away from getting to the point of having this like, digital mat that sits
Right.
with.
That's scary, but yes, let's do it. No, that's awesome. I love it. So, hey, I want to be respectful of your time. I know we're out of time here, but I love the conversation. I really appreciate you being on. I think it's great. If people want more information about what you guys are doing at Alger, about the concentrated equity ETF, what is the best place for them to go?
Yeah, I think you could go to our website, www.alger.com. For CNEQ, it's an actively managed ETF that you can just buy in the open market, like a ticker. So CNEQ, and you can effectively buy it like you'd buy any stock. You can there's a lot of information that we've written a few different papers on AI, which I think are fantastic. Everyone should read and touches on some of the things that we've talked about and are in process of writing some more, because I think it's such a structural imperative that people understand all of this. So our website has just a lot of different, it has different resources for people who are interested in any of this or in growth investing.
No, it's awesome. I'll put links in the description of this video as well, so people will have easy access to it. But yeah, Dr. Crawford, thank you so much for being here. I really appreciate it. And yeah, I thought it was great. Hopefully get a chance to talk to you again soon. So what I loved about this conversation, number one, is I just get excited when other people are excited about future tech and where things are going. And so I loved hearing her perspective on AI and the vast kind of opportunity that she still sees, which is a direct contrast to some of the things that we see online today, where everyone's saying it's over, it's a bubble, it doesn't make any sense. And hearing the view of, no, actually, it's the exact opposite of that. It's bigger than we can kind of imagine or envision right now, I think is more closer to where I land. And clearly with the companies that I put in my portfolio this year, it's obvious that that's kind of where my head's at. Now, whether that's right or wrong, we only know over time. And one of the things I thought was interesting is when she talked about the concentrated equity ETF was that, yeah, one of the differentiators or strengths of the ETF is that it's not diversified. And I've talked about this with my own portfolio with you guys that I don't have a diversification goal in it. And so from my perspective, who that ETF is for is people who want really exposure to high growth companies and don't want to be kind of held back by a diversification rule. And I thought that was a really clear differentiator. And it really makes sense when you talk about if you believe AI and future tech is really going to drive the market over the next decade, but it's not your area of expertise, then it may make sense to say, you know what, I'm going to go with these folks at Alger because I like their method, I think they're experts, and that's where I'm going to put my money. So again, it's about understanding what ETFs can bring to your portfolio and maybe how they complement the rest of the stuff that you have based on what your goals are as an investor. But I was excited she brought up Cloudflare and edge computing because that was a big part of my thesis with them, and you all hated it, but that's okay. I'm excited about it, and I'm going to see where it goes. But let me know what you thought was the most interesting part of the interview down in the comments. I'll put links to all the things that we talked about there in the description. And yeah, as always, hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you guys in the next one. Peace.